Every day, numerous decisions are made by every person. We make decisions as individuals. In the family, housewives makes decisions. And those who are working or those who are administrators at different levels, they also make decisions. But we have to remember that these decisions are not made on the basis of some guesswork or intuition. Actually, these decisions are made after thoughtful process, after examining all pros and cons, after examining all opportunities and all choices, then only we avail the best options. As far as business firms are concerned, they have to take decisions regarding demand, supply, stock, price, profit, output, availability of finance, etc. This subject, managerial economics, provides answers or solution to all these problems. And for this purpose, the person who handles this subject, that is managerial economist, that person must possess complete knowledge and information about the various techniques for taking the decisions. And these decisions may involve least cost combinations of the factors, best product mix, appropriate techniques of production, level of output to be produced, price to be charged, portfolio management, that is the decisions of investment in various options, amount of expenditure that is to be incurred on advertisement. And for all these decisions, what we have to do, we have to apply the concepts, the principles, the laws that we study in microeconomics or in macroeconomics. And by applying these principles in the real life situation, we are able to make apt and the suitable decisions. Now the question arises, what is the role of managerial economics in taking these decisions, particularly when there is high competition in the business, both at the domestic level as well as at the international level? Managerial economics has been emerged as a new branch of economics, and the basic reason why this new branch has emerged, the first reason is the business has become very, very complex. There has been tremendous expansion of business activities, and market conditions are rapidly changing. And not only the market condition, even the environment in which the business has to function or operate is also changing at a very rapid pace. The second reason is we have been using various concepts, various tools, various laws, various logics that we study in economic analysis. And without the understanding of these tools, we are not in a position to take appropriate decisions for the business. And the third point, which has explained as to why the need of managerial economics has become so important, is the fact that there has been tremendous increase in the demand for professionally managed and trained persons, manpower. And please do remember that we have to make decisions not only in a certain situation, in many situations, there is risk as well as uncertainty. The objective of every business firm is to earn profit, and most of the economists agree that this profit is the reward for risk and uncertainty. That means greater is the risk, greater is the uncertainty in the business, more is going to be the expected profit in the business. Now, before understanding the role or importance of managerial economics, we should first understand the definition or the nature of managerial economics. Many definitions of managerial economics has been given by different economists. But there are two definitions which are very, very important, which give comprehensive meaning of this term. One such definition is given by Spencer and Siegelman. And as per these two economists, managerial economics is the integration of economic theory with the business practice in order to facilitate decision making and forward planning by the managers. So it means there are three things in managerial economics which are very important. The first point is the fusion of economic theory and the business practice. And the second thing which is important in this definition is this subject helps in decision making. And the last thing, through whatever suitable decision that we make by using this managerial economic subject, we can plan our business for all times in the future. The second definition, which is very important, is the one which is given by Salvatore. And according to this definition, managerial economics is the application of economic theory with the use of tools of analysis so as to know that how organization can achieve its aims and objective in the best possible manner. This definition tells us that managerial economics, like the previous definition, it is integration of theoretical economics and techniques of decision making. So we put them together, or in brief, we can say managerial economics is nothing but it is actually applied economics. This is the reason why another terms which are used for managerial economics are applied economics, business economics, and the third term which is used for managerial economics is economics of business firms or economics of managers. The basic purpose of optimal utilization of resources is effectively served by this subject. That means organization or business firm or company can achieve its objective or aim in the efficient manner. And what is the aim of the business? What is the aim of the organization? The aim of business is profit maximization or sales maximization. There are some other alternative also, but the prime objective of every business firm is maximization of the profit. The secondary objective may be sales maximization. Even when objective of the business is to sales maximize, its ultimate goal is again going to be the same, that is profit maximization. That means some firm fix profit maximization as the ultimate goals. Some firm feel that profit maximization is their not only long-term goal but also short-term goals. But those firms which treat profit maximization at the long-term goal, they would like to go for sales maximization. They would like to use various techniques to prevent the entry of rival firms. And gradually they will be able to capture the market. They will be able to maximize their market share. And ultimately, by eliminating their rivals and competitors, they will rule the market and they will be able to maximize the profit, and their profit will be much more than the profit received by other firms in the market. You must have seen that there are some retail outlets like More, Big Bazaar, Reliance. They may offer many products at a very, very low price, sometime on regular basis, at other times on some special occasions like Republic Day or 15th of August. And the price charge for certain product is so low that even shopkeepers and wholesaler will go to these retail outlets and would like to purchase as much possible. But they will impose the limit that not more than 4, 5 or 6 units of a particular product can be purchased against one particular bill. So here we notice that here objective is not short-term profit maximization. Here the objective is entry avoidance. Here the objective is attracting the customers. And once these customers become loyal to our organization, we can gradually increase the product price and we will be able to sell other products as well, which are made available at relatively higher profit margins. So overall profit maximization is assured by such objectives. So based on these definitions, we can understand the concept of managerial economics in a comprehensive manner. And from whatever definition that we have studied, we can understand that managerial economics is primarily microeconomics applied or applied microeconomics. So even when you start your business, your company, we will say that this company or this business firm is a microeconomic unit. But since every business firm has to operate within the broad framework of economic environment that is known as macroeconomic conditions, including national income, business cycles, international trade, government policy, tax, subsidies, tariff, exchange rate, firms have to take into account all these conditions in order to survive, grow, and earn profit. So we can say, though managerial economics is primarily makes use of microeconomics, but it cannot ignore the macroeconomic policies and instruments of the government. So we include both micro and macroeconomics in order to properly understand or fully understand this subject. Next subtopic is significance of managerial economics. There are numerous functions which are rendered by managerial economist who is making use of this subject, that is managerial economics. And the first function is forecasting of demand and supply. It is only through appropriate forecasting of demand and supply that we can avoid the situation of underproduction and overproduction. In case there is underproduction, we are actually sacrificing the profits which could have been realized had the production was appropriate and not under. Similarly, the situation of overproduction implies unnecessary blockage of capital. So through appropriate macro forecasting of demand and supply, we can avoid unnecessary blockage of capital on one hand, and we are not required to sacrifice the profit because of underproduction. Second function is production planning at micro as well as macro level. So that means how much production is required for different regions or different areas, for domestic economy, for exports. This is something which is also taken care of by the managerial economist. Third point is capacity planning and product mix determination. When we produce at the minimum possible cost, we say that there is no wastage of capacity. But when we produce below optimum level of production, we say there is wastage of capacity. And this wastage of capacity is also called as excess capacity, underutilized capacity. In the situation of underutilized capacity, on one hand, we are incurring higher per unit cost. On the other hand, we are foregoing the profits because of less production. So capacity planning is an important function of managerial economists. Next, product mix determination. And product mix determination means what are the various ingredients during the process of production. These are also taken care of by the managerial economist. And it is here that we also use the concept of economic order quantity. That is how much should be ordered at a particular point of time so that our overall cost is minimized. This is something which is taken care of by the managerial economist. Gone are those days where most of the producers used to produce only one particular product. There used to be specialization, but today specialization has been replaced by diversification. Most of the firms are producing multiple products. The advantage with multiple products is that in case the demand goes down for a particular product, then the resources can be diverted to produce the other product for which there is adequate demand in the market. So economics of various production line is also taken care of by the managerial economist. Then next point is economic feasibility of new production line. Over a period of time, demands change. There is change in taste, preferences, fashions, habits, traditions, customs, etc. So there may be new product which may be in more demand. So feasibility study of new production line is also taken care of by managerial economists. Then the sixth point is to prepare the overall development plans of the company. And finally, to prepare periodical reports on cost benefit analysis through appropriate pricing decisions and appropriate cost decisions at national and international level. And for all these purposes, the job of the managerial economist is to gather the information and to make the same available to the top management so that appropriate timely decisions can be taken by the board of directors in view of national and international development on economics and industrial matters. For example, when the government announced new industrial policy or new economic policy during 1990s, there was total change in the macroeconomic environment. The process of regulation was replaced by liberalization, privatization, and globalization. And it was because of this policy that even after 20, 30 years, many products are being made available to the consumer at much lesser price than their respective pricing before the new economic policy. And this is because of the benefits which we have achieved from competition, globalization, and liberalization. The business in which we are has to take into account many factors. That means the profitability, the sales, the market position of a business depends upon numerous factors. And these factors can be broadly divided into two categories. The first one is external factors. And the external factor will take into account inflation rate, per capita income, national income, volume of trade in the domestic economy, in the international economy. Beside this, the government policies regarding licenses, regarding subsidies, regarding taxation, regarding the incentives provided by the government to open up industries in a particular areas. These are the external factors which are very important in business decision-making exercise by the industry. Apart from this, managerial economists has to take into account various internal factors like problem of wages, price, production schedule, inventory policies, investment, expansion or contraction. As far as internal factors are concerned, these are very much within the control of the business firm, but external factors are not within the control of the business firms. Next subtopic is the difference between managerial economics and economics. The difference between managerial economics and economics has been explained through table number 1.1 on the basis of various points. On the basis of nature, we can say managerial economics deals with the application of the principle, laws, and the concept that we study in pure economic theory, and the same are applied to solve the problem faced by the business firms. Whereas pure economic theory only deals with the body of those principles and laws. Second criteria of difference is nature of economic principles. In the case of managerial economics, we apply normative microeconomic principles which involves value judgments. So in managerial economics, we are concerned with what decision ought to be made. So we can say it is prescriptive in nature. Please remember that whenever we describe the things as they are, it is called as a positive statement. But as far as managerial economics is concerned, we do not describe the situation. We rather give a value judgment. We are concerned about the fact what is right and what is wrong, or what particular part of a whole process is right and wrong, and to what extent. This is something which is to be understood by the managerial economists. So that means managerial economics is prescriptive in nature. It regulates to achieve the best possible idealized norms. But as far as pure economic theory is concerned, we deal with both micro and macroeconomic principle. It can be positive or normative. In the case of positive, we are describing the things as these are. So this positive economics is neutral between ands. So when we say when price falls, demand rises, this is a positive statement. But we do not say what is right, what is wrong. But sometimes we describe ideal situation also in economics that we must control the population of the country to increase the per capita income. So this is a normative statement. So positive statement describe the things as they are, and in normative statement we explain the ideal situation or the best situation. In brief, positive economics is what is and normative economics is what ought to be. So most of the pure economic theory is positive, but managerial economics is normative. Scope of study, as we have studied earlier also, managerial economics is micro in character. Here we deal with the problems of business firms. But in case of economics, we have both micro and macroeconomics. And in these two branches, we study the behavior and economic actions of individual economic units and the whole economy, respectively. So microeconomics deal with the study of individual economic units and their problems, and macroeconomics deal with broad national aggregates like national income, national employment, national output, and general price level. Focus of study. In the case of managerial economics, the main focus of study is profit theory. But in the case of economics, particularly microeconomics, we not merely study profit theory, we also study distribution theories like rent, wages, interest, along with their determination rate. Approach to study. In the case of managerial economics, we adopt, modify, or reformulate the existing economic models. And the basic purpose for the same is to study and solve the specific problem of the business firms. But as far as economic theory is concerned, we make assumptions and describe and study relationship between dependent and independent variables by generating economic models. Methodology. Methodology under managerial economics is pragmatic in nature, where we introduce some real aspects like objective of business firm, legal and behavioral constraint, environment and technological factors in order to solve the real life complex business problems. But here, many times we are also making use of other subjects with their relevant techniques like mathematics, statistics, operational research, and accounting. You must have heard about techniques like queuing theory, transportation problem, assignment problem, correlation, regression, sampling, which may be for small sample or large sample. So we are making use of, you can say, different subjects and their relevant techniques. But in the case of pure economic theory, we avoid such complex things, and we are simply making assumptions to solve theoretical issues, and we may be successful to some extent only in the case of pure economic theory. Last topic is scope of managerial economics. That means various things that we will study under managerial economics. These are included in chart 1.1 before you that shows the scope of managerial economics. So there are 5 different main topics which we study under managerial economics, and all these subtopics have only one particular goal to be achieved, that is profit maximization. So the first topic is demand analysis and forecasting. Under this topic, we study various concepts like demand schedule, demand curve, demand function, demand equation. As far as demand function is concerned, it shows the relationship between the quantity demanded and the factor which affect this quantity demanded. And through this demand function, We can say that quantity demanded for any product or service depends upon numerous factors like price of the commodity in question, price of other or related commodity, income of the consumers, taste and preferences of the consumer. For example, if we are specific to the services of, say, any airlines, the factor that we will take into account while purchasing a ticket of this airline, it is going to be the price of the airline ticket, the price of the ticket of the other airlines which are in competition. The price of airline ticket will in turn depends upon the price of air fuel. So we can say the demand for airlines tickets in general depends upon the price of the ticket of the other airlines, the price of the input, that is air fuel, the disposable income of the people. And this disposable income means the income left with the people after making payment for the direct taxes or the personal taxes. And the other factor which affect the demand for airline tickets will include factors like preferences of traveling by air or special benefits provided by the employer or the government. And these factors also depend on your age. If you are a student, you may get concession. So we will study all these factors in great details under demand analysis. This is going to be a separate chapter. We will study in greater details about all these topics about which we are discussing today. And when we want to analyze this demand, an analysis of demand means in case price is fixed at a particular level, how much is going to be the demand? This is estimated through demand function. And for this purpose, we will have to get demand function in equation form. For example, we say that Q is equal to 2 minus 3P. Q is equal to 2 minus 3P. Q stands for demand, and minus sign indicates a negative relation or inverse relationship between quantity and the price, and P stands for the price. So once we are having this equation, Q is equal to 2 minus 3P, we shall be able to know the demand at different prices of the commodity. So this means we have estimated the demand function. So estimation of demand function means we are able to know the values of constant. In general, the demand function or equation will be like this: Q is equal to A minus BP. A and B are constant. When we get the value of these constant, we say that we have estimated the demand function. Those of you who have studied mathematics or who are aware about the mathematics, for them I will tell you that here minus 3 is the slope of this demand equation. But please remember that this is not the slope of demand curve. Slope of demand curve is different from the slope of demand equation. Demand equation is shown in algebraic form. You have to just differentiate it to get the slope. And demand curve is shown in the graphical form. So when the equation is given like Q is equal to 2 minus 3P, minus 3 is the slope. But when we draw the demand curve, price is shown on the vertical axis, quantity is shown on the horizontal axis, the slope of the demand curve will be dq by dp. But this dq by dp is not going to be the slope of the demand curve. This is the slope of the demand equation. The slope of the demand curve will be dp by dq rather than dq by dp. The reason is on vertical axis we are showing the price. On the horizontal axis we are showing the quantity. So the slope of demand curve will be dp by dq, that is the reciprocal of the slope of the demand equation. But if you show demand equation like P is equal to 2 minus 3P, then the slope of demand equation and the slope of demand curve will be the same. Second topic that we cover under managerial economics would be cost and production analysis. Please remember that cost and production are two sides of the same coin. Both cost and production show the relationship between input and output. When this relationship is shown in monetary terms, we get the cost function. But when this relationship is shown in physical terms, that is non-monetary term, we get production function. So production function means the physical relationship or functional relationship between the inputs and output. Input means raw material, land, labor, capital, etc. And output means the finished product or commodity. So when we study the relationship between these two variables, input and output, we get the production function. But when we study the relationship in monetary terms, that is production and expenditure incurred on the same, we get the cost function. So under production function, we find out the technically efficient way of producing a commodity with a given input. That is the least cost combination of the factors. Our objective is to utilize the various factors of production in such a manner that we are able to produce maximum output with a given available factors of production or inputs. Or alternatively, when we are able to produce a given output by utilizing the minimum possible amount of input. Like estimation of demand, we can also estimate cost function also through forecasting. And estimation would again means whenever in any function, when we know or when we find out the values of the parameters, like in demand function Q is equal to A minus BP. So when you get the value of A and B, you can call them parameters. So if you get their values, sometimes you can also call them constant, but these are better described as parameters because parameter means something which are constant and their values are different in different situations. We have the third point, market structure and pricing policies. For a layman, market is a place where the goods are bought and sold. But today, market may not simply be a place where the goods are bought and sold, because today you can order for anything online. During this pandemic period, the definition of market has altogether changed. Even before this pandemic, we used to have online shopping, which has increased over time. So market cannot simply be associated with a particular place. Market actually implies the economic interactions between the market players, that is buyers and sellers. And through these interactions, we get equilibrium point, the point where market forces of demand and supply cut each other, and correspondingly we are able to decide the equilibrium price and the equilibrium quantity. The price so decided is called as invisible hand in the market. And this invisible hand clears the market or clears the situation of excess supply or excess demand. In case there is excess supply, the price will fall. If there is excess demand, price will go up. But ultimately, when we are at equilibrium point, there will be neither excess demand nor excess supply. We can think of price determination in different market forms, which may be perfect competition, monopolistic competition, oligopoly, duopoly, or monopoly. The names that I have used is on the basis of number of sellers in the market. In case there is only one seller in the market, it is called as monopoly. In case there are two sellers in the market competing with each other, we have duopoly. When there are few sellers in the market, we call it oligopoly. When there are many sellers, we call it monopolistic competition. And when there are large number of sellers, we call it perfect competition. In all these market forms, number of sellers are large, but we have divided the market on the basis of number of sellers. We shall study details about these market forms in the respective chapters. In the case of monopoly, where there is only one seller, no competition, there is maximum possible exploitation of the customers, unless it is a welfare or social monopoly of the government, like Indian Railways. We have situations of duopoly or oligopoly also in the public sector, like Bharat Petroleum, Hindustan Petroleum, Indian Oil. These are all public sector enterprises. So these public monopolies do not lead to exploitation. But in case of private monopoly, there will be exploitation. When we move from monopoly to duopoly, because of some competition, exploitation of buyer is reduced to a certain extent. When we further move to monopolistic competition, due to still greater number of sellers, with further increase in the competition, the exploitation of buyer is further reduced. And in the case of perfect competition, which is very, very rare to get, with large number of sellers and large number of buyers, there is neither exploitation of buyers and sellers. Agriculture sector is certain example of perfect competition, but we cannot give so many examples of such market form. Next point is investment analysis. In this topic, we deal with the planning and control of the capital expenditure. In an attempt to make profits or in an attempt to maximize the profit, firm has to decide whether or not to invest funds in the purchase of assets or other resources. The firm has to decide whether investment projects should be replaced, whether major advertising campaign should be undertaken or not. Now here, since expenditure is incurred today and the revenue is realized in future over a period of time, we must discount the future expected earnings using appropriate rate of discount. Then only we can compare with the expenditure incurred today. And in case the total present value of expected future earnings is more than the expenditure incurred today, we will accept the investment project. Otherwise, it is going to be rejected. In case there are several alternative investment proposals, we will find out net present value for different investment proposals. Wherever net present value is maximum, that project is going to be accepted. And depending upon the availability of further funds, more projects can be accepted. So the priority will be to first decide the project with highest possible net present value. There are numerous decision-making tools which we study in accounts or financial management, like payback period, average annual rate of return, net present value, profitability index, internal rate of return criteria. So we can use them to decide which particular project or project should be accepted. Finally, we have risk and uncertainty analysis. We know that whenever we take any decision, and here I mean decision by business firms, so such decisions will involve changes, and these changes may be known or unknown. So there are three different terms: certainty, uncertainty, and risk. We must know the difference between these three terms. Definite outcome associated with the known changes is called as certainty. But indefinite outcome associated with the known change will involve risk. And some of these risks can be calculated and we can have insurance also. But when the changes are unknown and the outcome is also indefinite, we are not able to measure the risk element. And this is something which is called as uncertainty. Insurance is not possible in the case of uncertainty. So we must know the difference between the risk and uncertainty. Risk include the one which can be calculated, but when risk is not calculable, it becomes uncertainty. Every business firm operates under risk and uncertainty. Decision making and planning is very difficult in such situation. If the knowledge of future were perfect, planning would have been done without any error, without any need for subsequent revision also. But business firms rarely have adequate information about future demand, cost, revenue, profit, etc. So we have to make the decisions, and plans are formulated on the basis of past data, current information, and future expectations or predictions. Many times we have to revise our plans in the context of new scenario that emerges over the time. So firms have to continuously engage in the process of appraisal of their business plans, and they make appropriate adjustment on the basis of variations in the demand, factor prices, behavior of consumers and rival firm, and so on. Whatever profit that business firm gets is generally considered to be the reward for whatever risk and uncertainty that the firm bears or takes. We know that there are four factors of production: land, labor, capital, and entrepreneur. The first three factors, namely land, labor, and capital, get contractual payments. Their payments are decided well in advance, irrespective of the profit of the business. But profit is the residual payment. Whatever is left after making payment to the three factor is retained by the entrepreneur. And if nothing is left after making the payment, which are contractual in nature, profit will be zero. If more payment is made as per contract or understanding, we may have negative profit, that is also called as negative profit or losses. Objective of every business firm is to maximize the profit or to minimize the losses. But apart from profit maximization, business firms has to consider some alternative goals also, like sales maximization, entry avoidance, customer satisfaction, satisfaction of the employees and the managers, because when all these alternative goals are fulfilled, the business firm will be able to get more profits. That is ultimate goal of every business firm.